testing the economy with more bank tremors, more Fed rate hikes, and the unimaginable prospect of a U.S. default. This is Bloomberg Wall Street Week. I'm David Weston. This week, Stephen Ross of related companies on Wall Street moving to Miami.
Miami is probably the most dynamic city in the country today.
And Melissa Kearney of the University of Maryland on thousands of college students gone missing.
The decline in enrollment is not an encouraging trend.
Global Wall Street had plenty to focus on this week as we began the week breathing a sigh of relief over resolution of last week's banking crisis over First Republic.
We are all very pleased to get the major source of uncertainty that was remaining from the recent bank turmoil addressed, and that is a good thing.
But then Treasury Secretary Yellen told us that we may have less time than we thought to deal with that debt ceiling problem.
Well, it would be absolutely disastrous for Maine, to be completely blunt.
And by Tuesday, we were back to worrying about the banks again, as each day seemed to bring news of another regional bank seeking a new path.
It's tumbling right now by 42% after saying it's weighing strategic options.
The TD Bank has agreed with First Horizon to terminate the previously announced merger, which had been agreed upon, let's be honest, before all the turmoil in the banks.
But despite the problems with the banks and concerns over the debt ceiling, the Fed on Wednesday went ahead with the 25 basis point rate hike it had telegraphed, with Chair Powell opening the door to a pause, but saying that inflation is still with us for now.
Inflation remains well above our longer run goal of 2%.
Then on Thursday, the European Central Bank followed suit, but said it does not plan to pause.
In light of the ongoing high inflation pressures, the Governing Council today decided to raise the three key ECB interest rates by 25 basis points.
And if all that weren't enough, on Friday, the U.S. jobs numbers came in much stronger than expected, adding another 253,000 jobs last month, though they took away some from the month before. And as important, the unemployment rate went back down to that record 3.4% level, and wages increased at a brisk pace of 0.5% month over month. Equity markets on Friday reversed all or most of all of their losses from the rest of the week, with the S&P 500 ending the week off a mere 0.8%, while the NASDAQ gained less than 0.1%. And the yield in the 10-year went all the way up to 3.6% and then all the way down to under 3.3% to end the week just about where it started, at 3.43%. To take us through the week in the markets and the economy, welcome back now Ellen Lee. She's portfolio manager at Causeway Capital, and Savita Subramanian. She's Bank of America head of U.S. equity and quantitative strategy. So welcome to both of you. Great to have you here. Let me start with you, Ellen, if I could. Given what we saw from the Fed, but then from the jobs numbers, what do we make of the economy right now and where it's headed?
Well, clearly inflation is still high, and Fed still has concerns around that. And the latest job numbers still indicate that there is more slowing down to do. However, what's happening with the regional banking crisis, I think that will help in this effort, but there's still more work to be done as inflation is not quite there, and also the slowdown is not at a pace that we would want it to be in the current environment.
So what about you, Savita? We heard about a possible pause maybe on Wednesday. Is that still viable after the jobs numbers we saw on Friday?
I mean, look, I think we're in a data-dependent environment, and the data so far is suggesting we're probably not going to see that rate cut that everybody is hoping for by the end of the, in the next couple of quarters. I mean, our view is that inflation might remain stickier and higher for the rest of the year. I mean, if you look at jobs, a big part of the tight labor market is just the great resignation during COVID, and those folks haven't come back yet. So, I think it remains tight in certain parts of the economy.
So, Savita, let's talk about the equity markets. You are one of our 24 elves, I'm delighted to say. Thank you for being here. And you're sort of in the middle of the pack, $400 on the EPS and $4,000. 200 EPS and $4,000 on the S&P 500.
Yes.
Are you inclined to change that at all, given what we saw this week?
I'm right in the middle of the consensus elf, I guess. Well, I think we're a little lower than consensus on earnings, and I think think, if anything, I would be inclined to move that higher after what we've heard over the last few weeks. I mean, what really impresses me about earnings season is that guidance has been very positive. Despite every reason that companies have to guide down on this year's earnings or next year's earnings, they're actually guiding above what consensus is expecting. So I was surprised by that optimism. We're also seeing beats across the board, not just in technology stocks, but also in financials and healthcare. So it's been a very healthy earnings season relative to what folks were expecting coming into it. I think on the market itself, what I worry about is that it's still very tech top heavy. And that's the part of the market that I'm actually more concerned about from a rate risk perspective.
Ellen, what about tech? Tech had been a leader for a long time, then it sort of gave up leadership. Who's going to lead now?
I mean, we believe in the next cycle with themes like energy transition and more automation and energy infrastructure build and onshoring. We think industrials will be more at the head of market leadership, as we are hearing not only in the US, but also in Europe of continuous CapEx plans because of the change that's needed to get us to the next era. And again, with interest rates where they are, if we believe the zero rate interest rates are not back, the biggest beneficiaries of that actually reside in the tech sector, and we don't think that will come back. And therefore, we believe in sectors like industrials and energy will lead the next rally.
Savita, you've been talking about capital investment as well,
Yeah.
and really what that might mean for productivity down the road.
Very bullish on CapEx, and I think that's bullish longer term, although unfortunately you don't typically see productivity gains immediately. It takes a couple of years. I think there's a lot of really positive trends taking place in the market. You've got efficiency. We did a word count on the word efficiency during transcripts, and it was like through the roof. Everybody's talking about getting more efficient, and they have reasons to get more efficient because we're no longer in this zero interest rate environment where all you need to grow earnings is, buying back shares. I think we're past that point where the easy money from earnings, margins and globalization, that's behind us. But we're now in an environment where we could see healthier earnings growth from actually getting more efficient. So I think that was what I came away with this, over the last couple of weeks. Companies are doing exactly what they should be doing. They're dealing with higher costs, trying to preserve margins by getting more efficient.
Yeah, exactly. Particularly when you don't have as many workers to go around. You have to get more efficient,
exactly.
Don't you?
Automation is a big theme right now.
Exactly. Okay, Savita, Subramanian, and Alan Lee are going to be staying with us as we return to the volatile story of the regional banks. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. The regional banks were back in focus again this week, as the crisis with First Republic was no sooner over than we were talking about PacWest and Western Alliance. And then we got word that the TD Bank deal for First Horizon was off. We asked Torsten Slok of Apollo for his take on why regional banks were having such a tough time of it. And he answered with one of his famous charts.
What is noteworthy is what has happened since late February. Since then, we have seen the interest rate on 3-month CDs go up for small banks and go down for large banks. Specifically, small banks are raising interest rates on CDs because they're trying to attract deposits, whereas large banks have actually been lowering interest rates on CDs because they have more than enough deposits. And this discrepancy is highly unusual if you go back in time, because normally both large banks and small banks move interest rates up together or down together. But what is really unique about this situation is how smaller banks have had to increase interest rates on CDs and interest rates on deposits to attract deposits to the institutions. The implication, of course, for profitability is that, well, if this now continues for quite an extended period, the implication is that profitability in the smaller and the regional banks is going to be more under pressure, simply because they have to raise interest rates to attract more money to get deposits.
Ellen Lee of Causeway Capital and Savita Subramanian of Bank of America are still with us. So, Savita, let me start with you. We heard earlier from Ellen the reference to credit, not a crunch, but tightening certain credit. What could that mean for equities?
Yeah, I mean, I think so credit crunches are usually negative for equities. I think in this case, it's not going to be what we expect. And, normally banks and financials get hurt the most. But if you think about the last 10 years, the lenders haven't necessarily been the big SIFIs, the regulated banks. It's been more regionals. It's also been, private equity, venture capital, companies raising debt. I think what's also interesting is that the money that companies are raising isn't necessarily hasn't gone to CapEx and building stuff. It's really gone to share buybacks and maybe tech CapEx. So I think this credit crunch is going to look very different from what folks are gearing to, the idea that CapEx is going to trend lower, consumption is going to trend lower. Consumers and corporates are actually really healthy. We haven't seen a real CapEx cycle in a very long time. We haven't seen money spent on, productivity and efficiency. So I think that's the theme that we're focused on. When it comes to the banks, I think dispersion is very important, and it's actually a great time to be Ellen, where you're picking securities, because I really feel like this is a stock picker's market. Large banks are very different animals right now. They've been regulated and watched by the government. They've been disallowed from taking on a lot of risk and are sitting in a much better position. I think that for both ends of the spectrum, the secular challenge for banks is going to be giving back higher rates to consumers. But, as Thorsten's chart shows, there is clearly a difference in terms of the lay of the land right now.
Ellen, Savita says it's your market. You're the stock picker. Okay, so what stocks are you picking?
There's plenty to choose from, but just on the regional bank situation, I would dig deeper and say what Thorsten talked about is absolutely true. Cost of funding for regional banks are going up. They have been long beneficiaries of looser regulation. That's definitely changing. And there are more options for deposit holders to move money to other places where they'll get a higher yield. So we can easily say regional banks are challenged, but a stock picker like us, we're going to do the work and figure out which banks have a healthier capital ratio, which enables them to have a lower cost of funding. And also, we're going to look at the deposit base. The more granular the deposit base is, the stickier the deposit. I think one of the reasons why SIVB was challenged was their average deposit was in the 6 digits. So when rates go up, that deposit is more vulnerable to seek yield and returns elsewhere. So when you're looking at regional banks for a stock picker like us, we are going to be doing the work to find areas where there will be opportunities and price dislocation. And on another theme, in terms of stock picking, we are finding areas where there are good operational restructuring stories, as well as latent COVID recovery names like Rolls-Royce. Stock is up 70% despite what's happening in the banking market in the first quarter. And then thirdly, I would also talk about, Savita mentioned earlier about companies beating earnings. There are areas where companies have specific idiosyncratic risks where it has been underappreciated. And when those companies beat, the market is rewarding them very handsomely.
So what about Savita? As you look at equities, are there some idiosyncratic areas, particularly when it comes to credit, that are getting hit worse than others? I mean, everybody's interest rates are going up, but it may hit some companies differently from others.
Yeah, absolutely. So, one of the big surprises to me is when you look at some of these so-called defensive areas of the market, like healthcare or telecom, the credit risk is actually higher than you would expect, whereas energy, materials, commodities, which are typically, kind of at the epicenter of most credit downturns, are in a much better position. They've been deprived of capital for many, many years. They've become very disciplined about cash return and balance sheets and capital allocation, whereas the companies that have gotten more easy money might not be in as great a position to handle this market increase in interest rates. So, healthcare was, I think it's the 4th highest industry in terms of floating rate risk sitting on balance sheets, which means they're going to face that move in debt a lot faster than other sectors.
I did not know that. Quickly here at the end, Ellen, you like Europe when it comes to securities. Why is that?
Well, first of all, Europe valuation is much more attractive versus U.S. Secondly, in terms of a higher interest rate environment, that should be advantageous. And thirdly, think about the energy crisis that Europe is going through right now. And they have to shift their energy infrastructure, which is a very strategic element of an economy. So that spending is going to continue. And not only that, they are leading the efforts on decarbonization. And again, that will act as a fiscal stimulus for the growth of the economy. And again, Europe has had very little spending in infrastructure the last 30 years.
Yeah.
So this again will work in the favor of companies that are in energy and industrials to fuel economic growth in the next decade.
Yeah, it's fascinating. And I did not know that actually about healthcare. It's a fascinating point, Savita. Thank you for bringing it to us. Thanks so much to Savita Subramanian of Bank of America and also Ellen Lee of Causeway Capital. It's time now for our weekly look at Wall Street week past. Back in April of 1991, the #1 movie in the U.S. was Out for Justice, starring Steven Seagal. The #1 song was You're in Love by Wilson Phillips. And as now, people were worried about the banks, with Louis Ruckeiser taking us through the problem as he saw it back then.
Let's see why frightened Americans, looking at the financial scandals of recent years, have begun to ask, is it safer under the mattress? In the past 4 years alone, more than 750 U.S. banks with deposits of $70 billion have closed. So far this year, there have been 22 more bank failures, representing assets of another $25 billion. The Federal Deposit Insurance Corporation's fund, which guarantees that depositors won't be left in the lurch, has steadily dwindled in recent years. In 1985, the fund had $1.19 to cover every $100 of deposits. Today, it has only 17 cents per $100.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We've all been talking about it, the leaving of major financial firms from New York City and for that matter from Chicago to go south to Miami. Some people have been calling it Wall Street South these days. Well, one person who was ahead of the times on this, really down there developing particularly commercial real estate, is Stephen Ross. He is the founder and chairman of Related Companies. So, Stephen, thank you so much for joining us. You've got a big new advance in your strategy about commercial real estate down there. Talk to us about One Brickell City Center.
Well, we're very excited, to be here in Miami. Miami is probably the most dynamic city in the country today. When you look at statistics of where growth is occurring, Miami leads the way, South Florida leads the way. And so being able to develop what we believe to be the biggest building in Miami at a location that's main and main, with all the technology and all the things that Related puts in their buildings. And I think, people were looking to be a tenant in a Related building today, as evidenced by our success in New York and Hudson Yards, which really continues to grow as well.
Now, obviously, you're very big in West Palm Beach. This is Miami we're talking about now. How does it fit into your long-term strategy? What comes next?
Well, right now, we're continuing to build in New York, and we're very excited about New York. But Florida is really the growth, part of the country today, and where there's, need for Class A office space. It really needs, it's more than just delivering office space. It's really, building communities, building cities, and making sure that those cities have the hospitals, bringing schools, and all the amenities that new tenants want in relocating to Florida.
Has the situation with interest rates slowed you down at all? You talked about Hudson Yards in New York. You've got development down in South Florida. We had somebody actually who knows something about commercial real estate on Bloomberg recently, Josh Friedman, who said there's some carnage going on in parts of commercial real estate. Are you experiencing carnage?
No, we're not experiencing carnage. As a matter of fact, tenants today are looking to find Class A office buildings that are new, that embody all the latest in technology, and where people want to work. It's really the Class B buildings where the carnage will take place.
So how is Hudson Yards going? Are you having problems with people pulling back on Hudson Yards?
No, just the opposite. I mean, we are really experiencing a lot of activity at Hudson Yards. Corporations looking to grow, relocate there, because we really offer a very unique type of product. We're part of a mixed-use product where restaurants, it's very safe, it's easy to get to, and the buildings are the highest quality in New York City. So we've been very fortunate that we have a lot of activity, and almost monthly we're announcing new leases. We've done over 11 million square feet already in a short period of time. I mean, when you look back at it, we started Hudson Yards, before we even finished it, and it was built what was considered a wasteland, and we are now, before we opened up, I should say, we were getting the highest rents in New York City. So it's really, an area that it attracts the best of the tenants because that's where their employees want to work.
Stephen, let me ask the question the other way around. Valuations on a lot of these properties are coming down because of the interest rates and some of the tightening of credit. Does that present an opportunity for you related? Are there buying opportunities right now as some of the prices are coming down?
Well, I mean, today I'm sure the prices are coming down dramatically. It was advertised, last week, a large office building in San Francisco was trying to be sold at 80% of its former value. And your question is, what is the market? I mean, once a building is kind of not considered worthy of tenants wanting to be there, what is the value? They don't really convert well to residential. So you're going to see a lot of carnage in Class A, older Class A buildings, as well as the Class B market. We got to get people back to work. And they want to go to a place. I mean, today I believe that corporations are going to insist it's a question of time till they have people working at least 4 days a week.
So, Stephen, let's make a turn here to sports. You and the Miami Dolphins, you are hosting the Formula One race down in Miami this coming weekend, actually. Give us your sense about the F1 races. It's gotten very popular in the United States right now. How does the money work? Do you make money off of this? I mean, I know it's centered at your facility down there.
Well, I would hope so. I mean, yes, but when you own a sports team, you're really doing something to really enhance the community, to bring it together. It's about the economic development opportunities that arise throughout the whole area, and certainly South Florida benefits. I mean, we are making money on the race, but it's, when you own a sports team, it's a responsibility you have to the community to really benefit the community, bring it together, and create that economic development. And there's nothing bigger than Formula One today. I mean, that Netflix with the Drive to Survive has really got America very excited about Formula One, and we'll have close to 100,000 people this weekend. And what it's done for South Florida from an economic development standpoint is incredible. I mean, it's hundreds of millions of dollars of additional activity.
Stephen, finally, let's come back to something you and I have talked about before, Detroit. I come from Michigan, as you know. You've announced some plans there to really expand into Detroit, particularly with the University of Michigan and some of what's going on. Where are you on those plans?
Well, we're about to announce our first tenant and the beginning this year of our first office building, to be followed by the University of Michigan Innovation Center that really will act as a catalyst to bring jobs and really bring back downtown Detroit.
Stephen, thank you so much. Really great to have you back. That is Stephen Ross. He, of course, is the founder and chairman of Related Companies. Coming up, where have all the college students gone? We talk with Professor Melissa Kearney of the University of Maryland about the drop-off in high school students headed to college and what they are missing out on.
That wage premium that college graduates are getting in the economy is still really high.
That's next on Wall Street Week on Bloomberg. College. It's been the dream of American students and their parents for decades. The proven pathway to better jobs, higher pay, and social mobility. And, not incidentally, a crucial source for the highly skilled workers we need for the next generation.
And we're talking about what do we have to do in order to get our economy going, to make sure that we have a 21st century education system that's preparing our children how not just to be employees, but how to be employers.
But the risks and rewards of getting that college degree are coming under fresh scrutiny, as the cost of getting the degree have been rising much faster than inflation for both public and private colleges and universities. And the burden of borrowing to pay those costs has been so crippling that the Biden administration is trying to forgive a fair amount of it.
An entire generation is now saddled with unsustainable debt in exchange for an attempt, at least, at a college degree.
Even as Speaker McCarthy's new budget proposal would cut back on Pell Grants, which provide financial aid to the most needy.
The Department of Education shared how the Speaker's bill would remove up to 60,000 teachers from classrooms, eliminate student debt relief for more than 40 million Americans, and make college more expensive by reducing Pell Grants for millions.
And if all that weren't enough, the COVID pandemic hit college students particularly hard, as far fewer high school students enroll in college today than before the pandemic, leaving us with the critical question whether college is still worth it. And to take us through whether, in fact, a college degree is still worth it, we welcome now back to Wall Street Week, Melissa Kearney. She is professor of economics at the University of Maryland, as well as director of the Aspen Economic Strategy Group. So, Melissa, great to have you back with us. First of all, start with the basic question about enrollment. Is enrollment down? If so, how much? And is it because of the pandemic, or did it start before the pandemic?
Yeah, recent numbers on enrollment rates suggest that enrollment is down. This is the 6th year that enrollment is down. So it was starting to decline before the pandemic took hold, but the pandemic knocked a lot of high schoolers and young adults off their college-going plans. So we hear a lot, David, about the learning loss in elementary schools and high schools. I think another thing we really have to be focused on is how many graduating seniors would have otherwise enrolled in college who haven't, and they haven't come back yet. So this is concerning.
And how much of it's the cost of the whole thing? Because you saw that Wall Street Journal poll that said something like 56% of Americans don't believe a college degree is worth the price.
Yeah, I found those polling numbers really quite troubling. So as you mentioned, a small majority, but a majority nonetheless of American adults now doubt that a college degree is worth it. And that is that's just emphatically not true. So in general, people who graduate with a 4-year college degree will make back the amount of money that if they made good decisions that they would have paid to get that degree. So a college degree is still, an excellent investment in one's economic future. We know that college degree holders, 4-year college degree holders in particular, have an easier time finding work. They command much higher earnings when they do work, even in today's tight labor market. But as you mentioned, the price is it's hard to figure out. And so a lot of people actually think getting a college degree would be more expensive than it would be for them in particular.
Melissa, you mentioned the relative lack of transparency on exactly knowing what the cost is. It's hard to do a cost-benefit analysis if you don't know what the cost side is, whatever the benefit side is. Why is it so opaque?
They have their sticker price, their tuition price. That's their all-in price, what they charge people who can pay full price. That's also what they charge the government for people who are paying on behalf of others. But that's not what an individual student pays. So about 3/4 of students at 4-year institutions are getting some form of aid. And so it's just really hard for students to figure out until they've gone through the whole process of applying for financial aid, filling out the FAFSA, how much any individual school will take. There are a lot of efforts underway to make that pricing more transparent so students can figure out earlier in the process. But I think the real message that needs to get out is that students should not be discouraged from applying to flagship schools, selective 4-year schools, because they think they can't afford it. They should go through the process. Students who go to selective schools, who go to 4-year degree-seeking, degree-granting schools, they tend to have better outcomes. Those schools often have more resources and are better able to serve their students. So students should not be discouraged from applying, and they should take advantage of information that's out there, net cost calculators, information on school websites, to figure out what on average is a typical student paying to attend this school. And by the way, People should make smart choices. Like, public schools charge a lot less than private schools. So getting back to why a lot of people don't think a school is worth it or pursuing a college degree is worth it, you could get a lot of really good deals if you're looking at public four-year institutions as opposed to private, especially if you're looking at in-state tuition. Those net prices are much lower for typical students, and people should take that into account when they decide where to go.
So typically in economics, as I understand it, you understand it much better than I do, in supply and demand, if the supply starts to come down, it might put some pressure on the system. If, in fact, we're getting less enrollment, do you see any indication some of these institutions of higher learning are saying, we got to get our act together, we got to be, for example, more transparent, more direct, and by the way, even give a sense over the 4 years what's going to happen in the out years, because one issue is how much you're going to raise it once I get in?
Unambiguously, the decline in enrollment is not an encouraging trend. Whatever pressures it might put on some schools that are losing students, I think the decline in enrollment is really troubling because, as we said, a college degree really does grant an earnings premium to students who attend and complete a four-year degree. So the earnings premium going to college workers was rising tremendously in the 1980s and 1990s when demand for college-level skills really took off and the supply of college-educated workers didn't keep up. Since 2000, that wage premium has stalled. But importantly, it is still tremendously high. So in a typical year, let's just take 2019 before the pandemic, someone with a four-year college degree on average would make about 88% more a year than a full-time, full-year worker with just a high school degree.
When you talk about the earnings premium, it surely must depend in part upon what you study and what line of work you go into, right? I mean, I can just imagine, for example, what the demands are right now for sort of technology and some of the expertise in technology are very different from what they were 30 years ago.
Absolutely. And this is a really important point. So in general, even though I'm really emphasizing that a college degree is a good investment in one's future, the fact of the matter is not all institutions and not all majors deliver large earnings premiums. And that, again, is something that students have to take into account and have to make good decisions about where they're studying and what they're studying. And that information, too, is now much more readily available than it used to be in the past. Students can look up what is the typical earning path for someone who pursues this major, who attends this institution, and again, make smart choices.
So, Melissa, as you look at the decline in enrollment, what about the demographics of it? Is it affecting some people more than others?
Yeah, the decline in enrollment has been much larger among men than women, which is, women are doing better overall when it comes to young women getting college degrees, and so this is worrisome. And the pandemic-related decline was especially pronounced among non-white men. Again, this is another reason why these trends are particularly worrisome. We think a college degree is a great engine of upward mobility, and we worry if kids from lower-income homes, from non-white families in particular, are the ones who disproportionately had their college-going plans knocked off track.
Okay, Melissa, thank you so much for being back with us on Wall Street Week. That's Melissa Kearney. She's professor of economics at the University of Maryland. Coming up, the Fed told us this week it might just pause, but will the jobs numbers let it pause? We asked Stephanie Flanders. She's senior executive editor for economics and government on Bloomberg.
That does tell you something about the underlying strength of this economy and certainly of the labour market, which has continued to confound the Fed.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It was a week full of economic news as well as actions by central banks. And to take us through it all, we welcome now Stephanie Flanders. She is Bloomberg's senior executive editor for economics and government and also the host of Stephanomics. So, Stephanie, thank you so much for being here. Everything's connected to everything else as far as I can tell, but let's start with the Federal Reserve decision on Wednesday, raising 25 basis points, not exactly saying what comes next, but at least opening the door to pausing. Is it justified, the idea of a possible pause, given where we are with the economy in the United States?
Well, of course, we've ended the week with a really strong employment report. We've had 10 interest rate increases in a row, but now 13 payrolls numbers that exceeded expectations. And, you know, David, economists we expect them to be wrong, but they're not usually wrong in the same direction every month for over a year. So that does tell you something about the underlying strength of this economy and certainly of the labour market, which has continued to confound the Fed and made its job quite difficult in trying to balance that tightening, that historic degree of tightening in the last year against the sort of justified fears of a creeping credit crunch, problems for regional banks and, you know, still inflation above target.
Well, let's talk about inflation just for a moment, the connection between the strong labor market. And by the way, including in those jobs numbers were some pretty robust wage gains month over month. So as a practical matter, have we really got our arms around inflation? Do we have any reason to believe that the monetary policy of the Federal Reserve thus far is having a material effect? It's having some effect, a material effect on inflation.
Well, I think it is one of those things that has the policymakers in the Fed wondering, you know, has the transmission mechanism that takes these rate increases out to the broader economy, has that broken down? Has it become slower than in the past? Or is there something specific in the sort of post-COVID US labour market that's causing a delay but not an end to that transmission of tighter policies? I think what has changed is you have in these problems in the regional banking system, which I know we'll probably talk about, you know, the failure of yet another bank. That is telling you that there's something that is very tangible that is going to quite shortly has to have an impact on hiring, and that's the squeeze in small business lending. You know, you mentioned my podcast, Stephanomics, and we heard in this week's episode actually about somebody who wants to invest in a pickleball/restaurant having trouble getting a loan, a small business having trouble getting a loan. Now, you know, pickleball is a massive phenomenon at the moment. If you can't get money for that, I think we know that lending conditions are tightening, and that is, if small businesses are the ones most affected by that kind of lending squeezing out, tightening up, drying up, and it's small businesses that are the source of most job growth. So it may not happen this month, it may not happen next month, but we do now know that this labour market is going to cool, and we have to assume that's going to bring down inflation, might also cause a recession.
Well, let's talk about recession specifically. I want to come back to the regional bank issue in a moment, but the economists have been predicting a recession, the likelihood of recession for some time now. Do the jobs numbers help put a lie to that? Is there any prospect on the horizon right now of recession, given what we're seeing in the strength of the labor market?
Look, I think those who have all along considered it to be impossible to have that soft landing that the Fed is certainly hoping for, are not budging, even in the face of these numbers, because for starters, you've got a little bit of weakening below those headlines. So you've got revisions in previous months to the payroll figures. The household survey is a little bit weaker than it's been, but also, as I just mentioned, this creeping credit crunch that's happening, and it's going to primarily affect small businesses, those that can't raise debt in the markets that are reliant on banks. You know, I think there we see quite a good reason to expect, if not a recession, then something very close to it. All of our monitoring, the recession probability monitor, you know, maybe take it with a pinch of salt, but we think it's still more likely than not that we'll be in recession in the second half of the year.
Stephanie, let's go to the question of the regional banks and the pressure we've seen. We had the Silicon Valley Bank, and then you had Signature Bank, and every time we would come up, we say, oh, it's really idiosyncratic. It was some special failure of the management there. And then we had First Republic. Well, that's a different sort of idiosyncrasy. This week, we saw PacWest, we saw Western Alliance. It seems like every time we look around, there's another idiosyncrasy popping up. At what point does it become systemic rather than idiosyncratic?
Yeah, and I think we're starting to say idiosyncratic is if you're a bank that's not one of the big four banks in the US at the moment. That's starting to feel like the divide, because almost every other bank at one point or another has been under pressure, and almost every other bank in the US may not be in the kind of difficulties that we saw, the kind of extreme business model, extreme disregard of risk that we saw in some of those other cases, but is certainly facing a kind of fundamental issue. Inverted yield curve makes it very severely inverted yield curve in the key part of the market between 3 months and 10, that making it hard to make money, and this long riding kind of expectation that you can make profits by not passing on short-term policy rates at a time when short-term policy rates are rising. Well, that's harder and harder in a world where we know we can have these digital, instantaneous, massive falls in deposits and bank runs. I think there are questions about quite a lot of banks in the US right now. Not that they're going to survive, but certainly that it's going to be quite hard for them to make money in the near future.
Except for the very big ones, as you suggest. They seem to be doing very well. Thank you, ma'am. Does the Federal Reserve face a form of a zero-sum game here, where either it goes after inflation with increasing rates, or it helps the banks by not increasing rates or even cutting rates? Because part of the problem here, obviously, is an interest rate risk issue that was created, maybe intentionally, maybe it's a good thing, by the rapid increase in the rates.
Well, that is, that's how the policy is supposed to work. In many ways, at least it's not aimed at reducing the bank's ability to make money or challenging its business model, but it's certainly aimed at tightening credit conditions, reducing lending, and reducing economic activity as a result of that. I think we've got to a point, though, where the Fed and indeed other central banks are so keen to persuade us that they're not going soft on inflation as a result in response to these concerns around the banks, that there's almost a risk of going the other way. You could see that with Jay Powell this week. There was absolute determination of that separation principle that we are going to continue in our battle against inflation, and we have other tools. We're thinking in a separate way about the banks, but they obviously can't be completely separated.
So everything you've just discussed would be plenty. But on top of that, we had Janet Yellen, the Treasury Secretary, this week saying, by the way, that so-called X date, when the government will really run out of money and not be able to pay its debt, maybe as early as June 1. We have meetings coming up next week of the president with leadership in Congress. Give us a sense of how the debt ceiling crisis may play across the issues we've been discussing.
Well, when we talk about the US economy dodging recession, so we're basically saying that it's going to shrug off the effect of the credit crunch in the smaller lenders that I was talking about earlier, but also that we won't have some default moment or a big increase in financial tension around fears of a default in the next month or two. And we think, if that actually came to a head, that could have a very significant effect on the economy because, if you think about it, it means overnight the federal government has to balance its books, and that means very significant reductions in spending there and then. Now, we don't think it will come to that. But the kind of tensions around that, I think, do give Janet Yellen and the broader banking community. I was at the Milken Institute earlier this week in LA, quite a lot of concern under the surface about how this debt ceiling issue is going to play out. And some phone calls being made to Congress, but no real sense that people are getting a handle on it.
And finally, Stephanie, let's not leave Europe out of it. We heard also from the European Central Bank this week, who hiked as well 25 basis points like the Fed, but unlike the Fed, said, you know what, we're going to keep going. Madame Lagarde was, I thought, very clear about that. What's the difference between the two economies, and can the ECB take such a different route from the Fed if the Fed, in fact, does pause?
Well, of course, the European Central Bank started later. It's in a very different kind of situation. I think we tend to maybe, certainly if you talk to people in Frankfurt, they say we overplay the amount to which they're watching every move of the Fed and thinking about their move in relation to that. But I think it is the case that interest rate rise from the Fed and the talk of possible pause from the Fed, did give some cover to Christine Lagarde and her colleagues at the European Central Bank to reduce the amount of increase that they had. So we just saw that quarter point. They're slowing the path of interest rate rises. She did talk about another 2. We think it's more likely to be another 1, that you will see a pause in the summer because they're allowing their balance sheet to run off after June. So that's a continued form of tightening that they can rely on. But you're right that ultimately, if the market's right, for example, that the Fed's going to start cutting rates the end of this year, that could prove very difficult for the European Central Bank because they're certainly a long way from cutting.
Is there a prospect in Europe of having similar difficulties with the banks to what we've seen in the United States, given the fact that the ECB has been raising rates?
Well, it's interesting. We haven't got quite the same dynamic playing out. You don't have the same inverted yield curve and that kind of pressure on profitability of the banks. But on the other hand, you have the fact that the broader economy is much more dependent on bank lending. So a smaller problem, a smaller squeeze on the European banking system could have actually as large or even a larger effect on the economy. So, it is something that the European Central Bank has to look at. We are seeing credit conditions sharpen, tighten dramatically in the last few months. I think that'll be another factor that will cause the European Central Bank to pause in the summer.
Stephanie, thank you so much for being on Wall Street Week. That's Stephanie Flanders. She is Senior Executive Editor for Economics and Government at Bloomberg. Coming up, something old and something new. A 1,000-year-old monarchy gets a new king with a few modern touches around the edges. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Heavy lies the head that wears the crown. And as of this week, King Charles III of Great Britain knows just how heavy, like 5 pounds heavy, what with nearly 2,900 diamonds embedded in it. And that's after they cut it back for the coronation of George V in 1911. Before that, the crown was so heavy that no one could wear it, so they just carried it around in the procession. The British monarchy goes back to at least 1066, and its history and tradition are a good part of what keeps it going after nearly 1,000 years. But there are also some very modern aspects of this coronation. Take, for example, the effects of inflation. It is hitting us all.
Inflation is still too high. It's sticky. It's not coming down fast enough.
And that apparently includes the monarchy, which is cutting back on the number of days and the number of people, though it is still estimated to cost upwards of £100 million.
Amid a cost of living crisis, the King has asked for the service to be good value, but with a reported £100 million price tag, it's double the cost of his mother's.
King Charles rides in not one, but 2 royal coaches for the coronation, the oldest working coach in the world for heading back to Buckingham Palace from the cathedral after he's crowned. That is the Gold State Coach dating back to 1760. It was first used in a coronation in the 1830s. But to get to the cathedral, it's the much newer, air-conditioned, and much more comfortable Diamond Jubilee State Coach that Queen Elizabeth had made after she found the ride in the old one unbearable back at her coronation in 1953.
This coach beside me will be a key part of the procession going from Buckingham Palace to Westminster Abbey.
But for all the ancient customs and traditions surrounding the British monarchy, the U.S. has some more recent parallels. President Biden, for example, has his own sort of state coach. It's called the Beast, made by Cadillac, dating back only to 2018. And we had our own sort of modern coronation in New York just this week. Not of the King of England, but of King Jamie I of all of U.S. banking, as J.P. Morgan stepped in to rescue what was left of First Republic Bank, making the biggest bank in the U.S. even bigger.
We support and want community banks and regional banks. You need big banks, too.
And finally, King Charles shares with another president some of the difficulties in getting whom he wants to perform at his celebration, with reports that the new king was turned down by Elton John, as was President Trump back in 2016.
Yeah, I should have tried to be more ordinary. You were never ordinary.
But not so the Italian tenor, as Andrea Bocelli declined to perform for the 45th president of the United States, but answered the call from the new king this week because of reportedly his special relationship. But then again, King Charles does not have to face an election in 4 years to keep his new job. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.